Why structure it this way? I mean, if I'm a brilliant fund manager, why wouldn't I just want to build a smaller, fully owned suit? Why rely on leased armor that someone else can just, turn off?
It comes down to the relentless math of return on equity, or ROE.
Ah, right. The math always wins.
Always. Let's say you have a brilliant strategy that returns 5% a year. If you use your own $100 million, you make $5 million. That's fine. But it's not Wall Street Titan money.
Not at all.
Now, what if you use that same $100 million as just a sliver of equity to borrow $900 million?
Okay, so now you're playing with $1 billion.
Exactly. Now you have $1 billion at work. That same 5% strategy yields $50 million.
Wow.
Right. After paying a little bit of interest on the borrowed funds, your return on your initial $100 million isn't 5% anymore. It's pushing 40 or 50%.
That is a massive difference.
It is. Leverage is quite literally the only way to transform good returns into astronomical wealth.
Okay, that makes perfect sense. The equity is just the seed crystal. The leverage is what grows the iceberg.
Great way to put it.
But if equity is just the price of admission to the cockpit, someone else has to actually build and own the metal for the suit.
Yes, they do.
So who holds the title to the armor? If a fund is achieving scale through access, where exactly is that access coming from?
This is where we have to look at the prime brokers.
The mega banks.
Exactly. The funds are drawing this immense leverage directly from the balance sheets of the massive financial titans. We're talking Goldman Sachs, Morgan Stanley, JP Morgan.
They're the ones supplying the parts for the suit.
They are.
And it's not a simple loan, right? They aren't just cutting a check and saying, hey, pay us back in 5 years.
Oh, no. Not at all.
The mechanics are far more complex. The sources get into the deep plumbing of repo, margin, and securities lending.
Yeah. Let's drill down into the plumbing of a repo transaction, because it is the absolute lifeblood of this leverage.
Walk us through it.
Mechanically, if the fund wants to buy $100 million in treasury bonds, but they only have $5 million in cash, they execute a repo.
A repurchase agreement.
Right. They buy the bond and simultaneously sell that same bond to, say, JP Morgan for cash, with an ironclad agreement to buy it back tomorrow at a slightly higher price.
And then they take that new cash, buy another bond, and repo that one out too.
Exactly.
It creates this massive daisy chain. They're essentially pawning assets overnight, every single night, just to maintain their massive scale.
That's exactly it. It's a collateralized loan that rolls over daily. Which really brings us to the true essence of a hedge fund's operation.
Which is?
They aren't generating their own mass. They are literally connecting to other people's balance sheets to become massive.
Here's where it gets really interesting. Phrasing it like that, connecting to someone else's balance sheet, it completely shifts the paradigm.
It does, doesn't it?
Yeah. So instead of acting like a traditional standalone vault of money, is it more accurate to think of a hedge fund as a kind of financial API?
Oh, wow. I love that.
Right. Are they essentially just grafting themselves onto the balance sheets of these mega banks to literally borrow their reality?
Yes.
Like a piece of software that, it doesn't own its own massive server farm. So it just writes API calls to plug into the computing power of Amazon Web Services to run its operations.
If we connect this to the bigger picture, that is a much sharper analogy than the mech suit.
I think so too.
Let's explore how that API functions mechanically. A hedge fund, at its core, is just a highly sophisticated brain.
It's the code.
Exactly. It's a set of proprietary investment algorithms and strategies. But a brain needs a massive body to actually affect the market.
And Goldman and Morgan Stanley provide that body.
Precisely. They have the historically entrenched balance sheets, the deep reservoirs of capital. So the hedge fund writes the API call the trade request saying, I have the intellectual property, I have the strategy, but I need your capital to execute it at scale.
But hang on, this raises a huge question.
Okay, what is it?
If I'm Goldman Sachs, why on earth am I letting a highly leveraged, totally opaque hedge fund graft onto my balance sheet?
That is the million-dollar question.
Right. We just established that the fund has very little of its own equity. That sounds insanely risky for the prime broker. What is in it for the bank besides taking on a colossal risk?
Well, the answer is fees, spreads, and the mathematical illusion of absolute safety.
Illusion being the key word there.
Exactly. The prime brokers aren't doing this out of charity. Every single time that API call hits their system, every repo roll, every borrowed stock, the prime broker clips a fee, or they capture a bid-ask spread.
Ah, so it's volume.
It's an incredibly lucrative, high-volume business. And from the bank's perspective, they actually believe they've engineered the risk out of the system.
Through collateral and haircuts.
Right.
Explain how the prime broker uses that haircut to protect themselves.
So when a fund brings an asset to the prime broker to borrow against it, the broker doesn't lend them 100% of the asset's value.
They hold some back.
Right. If the fund brings a highly liquid treasury bond worth $100, the broker might apply a 2% haircut and lend them 98.
Okay.
But if they bring a riskier corporate bond, the haircut might be 15%, so they only get 85.
And that gap, that haircut, is funded by the hedge fund's own precious equity.
Exactly. The prime broker believes that even if the asset drops in value tomorrow, they have enough of a buffer to liquidate the asset and make themselves whole. They think they are perfectly insulated.
It's a deeply symbiotic relationship then. The hedge fund gets to be a giant without spending 50 years building a giant's vault.
Yep.
And the banks get to put their massive balance sheets to work, earning consistent yield without having to take on the direct operational risk of the hedge fund's specific trading strategy.
They are literally renting out their reality.
They are.
It is so symbiotic, and it reveals something fascinating about modern financial architecture. We tend to view these entities, the funds and the banks, as these fierce, independent competitors operating in silos.
Fighting each other for profits.
Right. But the reality is a web of intense mutual reliance. The hedge fund cannot exist in its towering form without the prime broker's balance sheet. It's an entity that exists almost entirely as an extension of someone else's financial foundation.
But anytime you have a towering structure built on a foundation that you don't actually own, you are introducing a terrifying level of vulnerability.
Oh, absolutely terrifying.
Which brings us to the final and, frankly, most dramatic aspect of this entire system.
The collapse.
Yeah. We see how the API works. We see the leveraged daisy chain. But what happens when the environment around those connections changes? What happens when the prime brokers decide they want to rewrite the API rules overnight?
This is where the brilliant mathematical design reveals its fatal flaw. Because the scale is borrowed, it can be recalled.
It's not theirs to keep.
Right. And the most common trigger for this kind of structural collapse isn't a bad stock pick.
It's not.
No, it's a sudden shift in the macroeconomic environment, particularly a rapid spike in interest rates.
So what does this all mean? Let's walk through the exact mechanics of that collapse, because it's not always intuitive. Why does an interest rate spike suddenly threaten this API connection?
It hits the structure from two sides simultaneously. First, when interest rates spike, the cost of all that borrowed money, the repo rates, the financing costs, goes up immediately.
So the daily toll just to wear the armor gets more expensive.
Exactly. And second, which is more dangerous, rising interest rates generally cause the value of the assets the fund bought with that borrowed money like bonds or growth equities to drop.
And that drop in asset value is what triggers the prime broker's automated risk systems.
Yes.
This is the infamous margin call.
Exactly. The prime brokers are constantly, second by second, monitoring the value of the hedge fund's collateral.
You never look away.
Never. If the value of those assets drops, that protective haircut buffer we talked about start to shrink.
And the bank's algorithm flags the account.
Right. They pick up the phone and issue the margin call. They say, look, the market has moved. Your collateral is worth less. You need to wire us $50 million in cash by 4:00 p.m. today to restore the buffer, or we start liquidating your positions.
And here is where the tiny equity base becomes a massive problem.
A huge problem.
The fund doesn't have $50 million in cash just sitting around. They are fully invested. They're fully leveraged.
So they have to start selling.
Right. To meet the margin call, they start ripping pieces off the suit, selling assets. But they can't sell their illiquid, complex positions quickly, so they have to sell their most liquid, highest quality assets first.
That's right. And this forced selling is what transforms a localized liquidity issue into a systemic event.
Because they're dumping so much at once.
Exactly. The hedge fund isn't just selling a few shares. They were dumping massive blocks of assets onto the market simultaneously. This sudden wave of supply drives the market price of those assets down even further.
Which means the collateral value drops again.
Precisely. Which triggers a second margin call from the prime broker, demanding even more cash, forcing even more selling.
It's just a vicious, accelerating downward spiral.
It is. But it actually gets worse. We have to factor in cross-margining and the broader market psychology.
Right, because prime brokers aren't operating in a vacuum. If Morgan Stanley issues a margin call, Goldman Sachs and JP Morgan are watching the market tape.
They see the blood in the water.
They see the forced selling. They know someone is in trouble.
Yes. The other prime brokers realize the environment has gotten riskier, so they proactively change the rules of the API.
Unilaterally.
Completely unilaterally. They decide a 5% haircut isn't enough anymore. Overnight, they demand a 10% haircut.
Oh, wow.
Now the fund has to post double the equity just to maintain the exact same positions, even if those specific assets haven't dropped in value yet.
It's the sudden death of liability liquidity. The funding just evaporates.
Poof.
Gone.
And this is the tragic irony of the whole system. The collapse of a highly leveraged hedge fund in this scenario isn't necessarily because their underlying investment thesis was wrong.
Right. They could have been totally right.
Exactly. They might have accurately identified deeply undervalued companies. They might have been completely right about the long-term fundamentals. But the market can remain irrational longer than you can remain solvent. The collapse happens simply because the liability side of the balance sheet froze.
The prime brokers pulled the plug on the API.
Yes.
It totally inverts how we normally think about financial ruin. I mean, we usually assume ruin comes from the asset side, right?
Yeah.
You buy a stock, the company goes bankrupt, the asset goes to zero, you lose your money.
That's the normal way, yeah.
But in this world of borrowed power, the asset side is almost secondary. You are destroyed because the person lending you the money changed the rules of engagement.
Exactly.
If the liability side freezes, if you can no longer roll over your repo agreements, your assets are basically meaningless. You are forced to liquidate at fire sale prices, which completely obliterates whatever tiny sliver of equity you actually had.
This raises an important question, and I think it's the most profound takeaway here.
Let's hear it.
The asset side of the balance sheet is entirely at the mercy of the liability side. We are conditioned to think our assets protect us from our liabilities. But for a highly leveraged entity, the liabilities dictate whether the assets are even allowed to exist.
That is so true.
It's a game of magnificent, breathtaking scale, but it requires perfect, uninterrupted trust and frictionless liquidity to remain standing. The moment that trust falters, the moment the prime broker demands tangible proof of reality, the shared illusion shatters.
It really puts things into perspective. We started this deep dive by challenging this common assumption of hedge funds as standalone, impenetrable fortresses of wealth.
Right.
And by digging into the plumbing of their balance sheets, we see them for what they really are. They're highly leveraged algorithms.
Yeah.
Incredibly light on their own equity, functioning basically as financial APIs.
Grafting onto the massive balance sheets of prime brokers to achieve their scale.
Yes. And we traced the life cycle of that borrowed scale. We explored how beautifully the mechanics work when the environment is stable, how repo markets and securities lending allow a small seed of equity to wield immense market influence.
It's elegant until it's not.
Exactly. Because we also walked through the exact mechanics of its rapid unraveling, how an interest rate shift alters collateral values, triggering margin calls, expanding haircuts, and causing the sudden death of liability liquidity.
And that's why understanding the structural anatomy is so crucial for you, the listener.
Definitely. The next time you're reading the financial news and you see a headline about a major fund facing a massive drawdown or liquidity crisis, you won't just see abstract ticker symbols flashing red.
You'll see the plumbing.
You'll understand the hidden mechanics operating beneath the surface. You'll recognize that it's not necessarily a story about bad stock picks. It's a story about the API connection being severed. It's the prime brokers pulling back their borrowed reality, bringing the giant to its knees.
It completely reframes how you interpret market volatility.
It really does.
And it leaves us with something incredibly vital to consider as we wrap up.
What's that?
Well, we spent this time dissecting the symbiotic yet fragile relationship between a single hedge fund and its prime brokers.
Yeah.
But if you zoom out and look at the entire global financial system,
Oh boy.
if these massive market movers, these entities that dictate the flow of billions of dollars daily, are essentially constructed out of borrowed trust, expanding haircuts, and interconnected liabilities,
Yeah.
how much of the broader market's stability isn't based on underlying value at all, but is simply a shared fragile agreement to keep the leverage flowing?